The power of entering early and waiting. In investing, people obsess over perfect timing. But history shows something more powerful than perfect entry. Reasonably early entry plus disciplined patience. The combination of early positioning and long-term holding creates asymmetric advantages that timing alone rarely achieves. 1. Time multiplies early capital. The earlier capital is deployed into productive assets, the more cycles of compounding it experiences. Even small return differences become enormous over long horizons. As Warren Buffett has demonstrated through decades of disciplined compounding at Berkshire Hathaway, sustained return over time is more powerful than short bursts of outperformance. Early entry doesn't require perfection. It requires participation. 2. The nonlinear effect of compounding. Compounding is not linear. Year 1 to 5, progress feels slow. Year 10 to 20, acceleration becomes visible. Year 20 to 30, growth becomes exponential. The earlier you start, the longer the exponential curve has to work. Waiting for the perfect dip often sacrifices the most valuable asset, duration. 3. Early entry reduces timing pressure. Trying to time precise bottoms creates psychological stress. Fear of missing out. Regret. Constant monitoring. Entering early with a long-term thesis shifts the mindset from prediction to participation. Behavioral research by Daniel Kahneman shows that humans overweight recent information. This makes late entry during euphoria common and early entry during uncertainty rare. The paradox. The most uncomfortable entry points often produce the highest long-term rewards. 4. Volatility becomes an ally. When you enter early and commit to waiting, downturns become accumulation opportunities. Market cycles work in your favor. Mean reversion enhances long-term return. Volatility hurts traders. It benefits patient capital. 5. Structural growth needs time. Businesses grow through earnings reinvestment, innovation, market expansion, productivity improvements. These processes unfold over years, not weeks. An early investor in structurally strong assets benefits from internal compounding, increasing competitive advantages, scaling economics. Time allows fundamentals to justify valuation. 6. Psychological edge of patience. Most investors cannot sit still. Research inspired by the work of Amos Tversky shows that loss aversion makes short-term declines feel twice as painful as equivalent gains feel pleasurable. Early entry combined with patience requires emotional resilience, but it eliminates the need to chase breakouts, predict turning points, react to every headline. Waiting becomes strategic, not passive. 7. Early plus waiting versus late plus precision. There are two common approaches. Late plus precision attempt. Wait for confirmation. Seek perfect signals. Enter after momentum builds. Early plus patience. Enter based on long-term thesis. Accept interim volatility. Allow compounding to work. The first relies on timing skill. The second relies on duration. Duration is statistically more reliable than precision. Important clarification. Entering early does not mean ignoring valuation entirely, speculating blindly, buying without analysis. It means acting before consensus certainty, accepting short-term uncertainty, giving capital enough time to mature. The strategic insight. Markets reward capital, conviction, time. If you have capital and conviction but lack time, returns are limited. If you have time and capital but lack conviction, you exit too early. The real edge is the combination. Final thought. Entering early gives you access to the compounding curve. Waiting allows you to ride it. Most investors focus on entry. Very few respect duration. But in long-term investing, time is not just a variable. It is the primary force.